So you wanted to dive into group life insurance, right? I get it. It can seem a bit, well, overwhelming. But that's why we're here, to really make sure you understand it, you know? We've got all our sources ready, and we're going to extract those key insights and make them really clear and relevant for you.
Yeah, think of it like we've done all the reading and the research, you know,
Yeah.
and we're just going to pull out those important bits. So you can grasp the essentials of group life insurance, you know, quickly and without feeling lost.
Exactly. No need to drown in technical terms or anything like that. So let's just jump right into it. What exactly is group life insurance? Like, at its core, what are we talking about here?
Well, simply put, group life insurance is basically a single contract, right? But it provides coverage for multiple people. And that's the big difference, right, from individual life insurance, which only covers a single life. And typically it's offered as annual renewable term life insurance. You know, that's the common form. And it's very often provided by employers, you know, or large associations for their employees or members.
So it's not like just me going out and getting a policy for myself. This is something different.
Yeah, it's a different beast.
Got it. So besides that obvious difference of multiple people being covered, what are some other key differences we should know?
So there are a few big ones. We've already touched on the number of lives covered, right? Multiple versus a single life. And then there's the typical form, which we mentioned, that group life is often annual renewable term. But individual policies could be term, like for a set number of years, or even whole life, which has that savings component and lasts your entire lifetime.
Right, I see. Okay, more people, often a year-by-year renewal thing. Anything else?
Yeah, underwriting's a big one. So in group insurance, they look at the group as a whole. You know, they're not usually underwriting each individual, like making them go through medical exams or proving their health. Whereas with individual life insurance, you know, they assess each applicant, their health, their lifestyle, all that stuff.
So easier to get into, potentially.
Could be, yeah. And then there's policy ownership, too. In a group plan, the employer or the association, they own the master policy, and the individuals, they just get a certificate of coverage, you know, outlining their benefits. With individual insurance, it's usually the person who's insured who owns the policy, or maybe a third party.
Ah, I see.
And then lastly, with the documents, employees get a certificate, and individuals receive that whole policy document.
Okay, that makes sense. It's starting to make a lot more sense. We're starting to get a pretty good picture of this. Now, let's delve a little deeper into how these group plans actually work. Like, what are the principles and characteristics that define them?
Okay, so group life insurance is still fundamentally a contract, right, between the policyholder, which is usually the employer, and the insurance company. So there is that similarity to individual insurance. It's just that with group life, you have this like third party involved, you know,
Right.
the employer, who is usually the policy owner, and then you, the employee, you're the certificate holder.
So the employer plays a pretty central role in all of this. What are their main responsibilities when it comes to these group plans?
So a few things. They select the coverage, you know, the types and amounts, they handle all the record keeping for the plan, and they manage the whole enrollment process for their employees. And this is important, especially in non-contributory plans, you know, where the employer pays the whole thing. They have to make sure that the plan doesn't discriminate in favor of the higher paid employees.
So fairness is a big deal.
Absolutely, yeah. Benefits got to be fair across the board.
Makes sense. Now, just to make sure this is all crystal clear, could you quickly recap those main differences between group and individual insurance that we've been talking about?
Sure, yeah. So underwriting group, look at the group, no individual medical checks usually, while individual insurance needs proof of your health. For ownership, the employer owns the main policy, employees get certificates, but in individual policies, the insured is often the owner. Policy type group is usually temporary, like the annual renewable term, while individual can be temporary or permanent. And then cost. Group tends to be cheaper for the insurance company, and your employer often helps pay, which makes it cheaper for you too. Individual insurance is more expensive for the insurer, and you pay the whole cost yourself.
Right, okay. And you mentioned certificates before, but just to be clear, so that certificate of insurance that I get as an employee, that's my actual proof of coverage, right? That's what I hold on.
Exactly. That's your document, right? The employer has the master policy, but your certificate outlines what you're covered for, what benefits you have under that plan.
Got it. So let's talk about who pays for this stuff. Our sources mention contributory and non-contributory plans. What's the difference, and why should I care?
Okay, so this is all about who foots the bill, right? So non-contributory, that means your employer pays the entire cost. You don't pay anything. And because they're covering everyone, The insurance company usually wants 100% of eligible employees to be participating in the plan.
Everyone's in.
Yeah, that's the idea. And the reason for that is it helps to balance the risk for the insurer. They don't want just the people who think they're going to die soon signing up, right? So for you, it's a great deal. No premiums coming out of your paycheck.
Yeah, that sounds pretty good.
Yeah.
So non-contributory, employer pays, everyone's in. What about contributory plans?
Okay, so with contributory, the cost is shared, right? The employer pays some, and the employees, they chip in too. And in these cases, the insurance company usually wants at least 75% of eligible employees to participate. So there's still that minimum participation thing, but it's a bit lower. And you'd contribute to the premium through payroll deductions.
Okay, so cost sharing, slightly lower bar for participation. Makes sense. Now, who can actually be covered under these group plans? What makes a group eligible for this kind of insurance in the first place?
Okay, so the fundamental rule here is the group has to exist for a reason other than just getting insurance, right? The insurance is like a side benefit. You can't just get a bunch of people together and say, hey, let's get a group life insurance plan.
Right. Can't game the system.
Exactly. So there needs to be, a genuine common interest or affiliation.
Insurance as a byproduct of the group's existence. Got it. What are some common examples of groups that would be eligible?
Okay, so the most common one is single employer groups, like all the employees working for the same company. But you also have multiple employer groups where, several smaller companies band together. And then, you see labor unions, trade associations, credit or debit card holder groups, fraternal organizations, even customer groups, like members of a credit union can qualify. And then there are trustee groups, which are set up by 2 or more employers or labor unions specifically to provide benefits.
Okay, so quite a range.
Yeah, it's pretty broad.
Anything else to keep in mind regarding eligibility for these groups? Any other, rules or anything?
Yeah, one thing to remember is that individual states might have their own specific regulations regarding group eligibility.
Huh.
So, for example, a state might require a group to have been around for a certain amount of time, maybe 2 years, or they might have a minimum number of members required to form a group for insurance purposes. So the specifics can vary depending on where the group is located.
Okay, so some state-specific stuff to watch out for.
Right.
Now, let's zoom in on the individuals within those groups. Let's say I'm an employee. What do I typically need to do to be eligible for the group plan?
Okay, so typically, to be eligible for that group life insurance, you need to be a full-time employee and actively working, right? So not on long-term disability or something like that. And then if it's a contributory plan, where you're sharing the cost, you also need to agree to those payroll deductions for your portion of the premium. And many employers also have a probationary period for new hires, maybe 1 to 6 months before you're eligible for benefits like life insurance. And then finally, once you are eligible, there's usually an enrollment period, maybe 31 days from when you become eligible to sign up. If you miss that window, you might have to prove your health later on to get covered.
Right. Sounds pretty standard, like a lot of other employee benefits.
Yeah, pretty typical.
Now, thinking about how insurance companies look at risk, what are the underwriting requirements when it comes to group life insurance?
So the main goal with underwriting, right? They're trying to minimize something called adverse selection. It's basically the tendency for people who think they have a higher risk of dying to be more likely to seek out insurance. And insurers, they want to avoid situations where, they're covering a group that's disproportionately made up of high-risk individuals.
Makes sense. So how do they actually figure out the risk if they're not individually checking everyone's health in those larger groups?
Well, they rely on the law of large numbers. So by insuring a large number of individuals, they can statistically predict the expected number of deaths within the group. The idea is with a large enough group, the high-risk and low-risk people balance each other out, and it becomes a predictable, profitable thing for the insurance company.
So safety in numbers for the insurer.
That's the idea, yeah. And that's why for larger groups, you usually don't have to go through those medical exams or provide a ton of health information to get covered. But for smaller groups, it might be a little different.
Why is that? Why is it different for smaller companies?
Well, the law of large numbers doesn't work as well with smaller numbers. The risk is less predictable. If you have a group of 500 employees, the insurer has a decent idea of how many claims to expect. But if it's only 10 people, a single death claim can really throw things off financially. So for smaller groups, they might ask for some proof of insurability just to get a better handle on the individual risks within that group.
Right. Smaller numbers, more potential for things to go haywire.
Right, exactly.
Okay, that makes sense. Our sources also mention that employees with disabilities can't be excluded from the group plan, right? That seems like a pretty important protection.
Yeah, that's right. So generally, plans can't exclude employees just because they have a physical impairment, like let's say someone who's paralyzed. They can't be denied coverage because of that. It's part of the non-discrimination in group insurance. So everyone who's eligible, regardless of their physical condition, should have access to coverage.
Got it. And the last thing on underwriting, what's this policy persistency that our sources mentioned? Why do insurers care about that?
So persistency is basically the percentage of insurance policies that stay active with the insurer over time. So people aren't canceling their coverage, not letting it lapse, and not switching to a different company. And insurers really like groups with high persistency, right? Because it costs them money to acquire new groups and set up new policies. So a group that jumps around a lot, from one carrier to another, that's seen as unstable and potentially less profitable.
So loyalty is a good thing.
In a way, yeah. It's
Yeah.
more about stability, I guess, from the insurer's point of view.
Right, I see. Okay, so insurers look at the overall health of the group, rely on large numbers for predictability, don't usually require individual health checks for bigger groups, can't exclude based on disabilities, and they like groups that stick around.
Yeah, that's pretty much it in a nutshell.
Okay. Now, once they've gathered all that information, how do they actually categorize the risk? Like, how do they say, okay, this group is this level of risk?
Right. So after assessing the group, they classify the level of risk. They usually have like a system with a few categories. You have preferred risk, which is for groups or individuals that are considered very low risk, and they usually get the most favorable premiums. Then you have standard risk, which is considered average, no extra charges or anything. And then you have substandard risk, where the group or some of its members are considered higher risk, and that usually means higher premiums to make up for that increased risk. And in some cases, if the risk is too high, the insurer might decline to offer coverage altogether. That's the worst case scenario. But generally, lower risk means lower premiums.
So it all ties together. Lower risk, better rates.
Exactly.
Okay. Now let's talk about some of the extra perks that can come with group term life insurance. There's this conversion privilege thing that sounds pretty interesting. What is that, and how could it benefit me?
Okay, so the conversion privilege, this is a really good thing for you as an employee. It gives you the option to switch your group coverage to an individual policy if you leave your job. If you get laid off or you resign or whatever, when your employment ends, you usually have a certain amount of time to convert your group coverage into an individual plan without having to prove that you're still in good health.
Ah, so you don't lose your coverage completely just because you leave that job.
Exactly. And the best part is you don't have to go through medical exams or answer health questions for that new individual policy. So if your health's declined since you first got covered under the group plan, this could be a huge benefit because you might not be able to get a new individual policy on your own at that point.
That's a good point, a real safety net. So is there like a time limit on how long I have to make that conversion?
Yeah, there is. You usually have 31 days from your last day of work to decide if you want to convert. And one thing to note is that if you were to pass away during that 31-day period, even if you hadn't applied to convert yet, the death benefit from the group policy would still be paid out to your beneficiaries. So you're still covered during that transition time. And then when you do convert, the premium for the new individual policy will be based on your age at the time of conversion, your attained age.
Got it. What if the whole group life insurance policy gets canceled? Like the employer or the insurance company just decides to end it. Does that affect my ability to continue coverage?
Yeah, it can, but most group policies have this provision that says if the whole master policy is terminated, anyone who's been insured for a certain amount of time, usually at least 5 years, can convert to an individual policy up to the amount they were covered for under the group plan. So there's some protection there, even if the group coverage goes away.
Right. Okay. That's good to know. So let's talk about who actually gets the money if, something happens. That's beneficiary selection, right?
Yeah.
Our source also mentioned something about incident of ownership. Can you explain what that means in this context?
Sure. So even though the employer owns the master policy, they don't get to choose who your beneficiary is. That's your right as the employee, as the certificate holder. You get to name and change your beneficiary, and that's considered an incident of ownership that you have within the group life insurance plan. So ultimately, it's your call who receives the death benefit, which is a pretty big deal.
Yeah, that makes sense. Gives you control over that part of it.
Yeah.
Can an employee ever name their employer as the beneficiary? Like, is that ever a thing?
Generally, yes. An employee can name their employer, but only if the employer has something called an insurable interest in that employee, meaning they would suffer a financial loss if that employee died. So, for example, a key executive, someone whose skills and knowledge are vital to the company, the employer might have an insurable interest in them, but they wouldn't typically have an insurable interest in like a part-time clerk or something like that.
Right, there has to be a financial tie there.
Exactly. Yeah.
Okay, and what about this assignment provision that's mentioned in our source?
So in some states, group policies might have this written assignment provision, which means you, as the employee and certificate holder, you can transfer some or all of your rights under the policy to another person or entity. But any assignment like that has to be in writing and filed with the insurance company for it to be legally valid.
Okay, so there's a process for that.
Right.
All right, so we've talked a lot about the standard type of group term life insurance, but there are some other forms out there. Let's touch on those. What's the deal with group credit life insurance? What's its main purpose?
So group credit life insurance, that's specifically designed to pay off a loan balance if the borrower dies before the loan is fully repaid. It's often offered by banks and finance companies when you take out a loan, and the premiums are usually based on the claims experience of the group, not so much on your individual age or health. And it's usually the borrower who pays the premium. Often they use decreasing term insurance, where the coverage amount gradually goes down as you pay off the loan.
Makes sense. The insurance shrinks as the debt shrinks.
Right.
What about blanket life insurance? That one sounds a little different.
Yeah, so blanket life insurance, this one covers groups of people who are all exposed to the same specific hazard. So think about passengers on an airplane or students and faculty at a school event. The key thing here is that no one's specifically named on the policy, and there aren't usually individual certificates issued. The coverage only applies if a loss happens because of that specific shared hazard.
Right, very targeted for specific situations.
Exactly, yeah.
Now let's talk about folks in the military and federal employees. Obviously big groups, important groups. What are their life insurance options like?
So the federal government has specific programs for them. You've got SGLI, Service Members Group Life Insurance, which offers a good amount of term life coverage for active duty military personnel. And it's group term life. And all eligible active duty members are automatically covered unless they specifically choose to opt out. And then there's FSGLA, Family Service Members Group Life Insurance Coverage, which covers the spouses and kids of those insured under SGLI. So spousal coverage is automatic up to a certain limit, or the service member's coverage amount, whichever is less. Premiums are based on the spouse's age, and kids get a set amount of coverage at no cost to the service member.
And what about when service members transition out of the military? Do they lose that coverage completely?
Well, they often have the option to convert their SGLI to VGLI, Veterans Group Life Insurance, which is a renewable term life policy they can continue after their service ends. And both service members and their spouses may even be able to convert their SGLI or VGLI coverage to permanent life insurance through private companies without having to prove their health, which is a really nice perk.
That's a big deal, especially after serving their country.
Definitely.
Okay, and what about other federal government employees? What's available to them?
So they've got FEGLI, Federal Employees Group Life Insurance. It's a group term life insurance program for federal and civilian workers. It's a separate program with its own rules and coverage levels.
Got it. Okay, we've covered a lot about the different types and features of group life insurance. Now, the inevitable question, taxes. How are these group life insurance plans treated when it comes to taxes?
Right. So for these plans to get favorable tax treatment, they generally have to follow some non-discrimination rules, basically making sure that the benefits aren't skewed towards higher paid employees. So for premiums, if you, the employee, pay your share of the premium, those payments aren't tax deductible for you. But any premiums that your employer pays for group life insurance are usually deductible for them as a business expense as long as they meet certain requirements. It's worth noting, though, if you're a sole proprietor or partner in a business, you can't deduct premiums you pay for your own coverage because you're not considered an employee in that context.
Okay, that makes sense. So what about the coverage I get as an employee? Is that considered taxable income to me?
So this is important. The first $50,000 of coverage your employer provides is generally tax-free for you. But anything over that $50,000 might be considered taxable income, even though you're not getting actual cash. The IRS has tables for calculating that, and it's usually reported on your W-2 at the end of the year. A lot of times, employers will structure their benefits based on things like your earnings, your position in the company, or they might just offer a flat amount to everyone. So keep that $50,000 threshold in mind, especially if your employer provides a lot of coverage.
Okay, so there's a limit on how much of that employer-paid coverage is actually tax-free.
Got it.
And what happens when the benefit is actually paid out to my beneficiaries?
So generally, if those proceeds are paid out in one lump sum, it's income tax-free for your beneficiary. But if they choose to receive the proceeds in installments, any interest earned on that unpaid balance will be taxable.
Got it. Okay, and our source mentions something called a retired lives reserve and using life insurance within retirement plans. Can you quickly explain what those are about?
Sure. So a retired lives reserve, or RLR, is basically a setup where an employer can make tax-deductible contributions to a special reserve account while you're still working. Those contributions aren't taxable income to you at the time, and then those funds are used to pay for your term life insurance premiums after you retire. And as for life insurance and qualified retirement plans like 401ks or pensions, they can sometimes purchase life insurance to provide a death benefit, but only if the plan documents allow it and it's incidental to the main purpose of providing retirement income. The tax stuff can be complicated there and depends on the type of retirement plan.
Okay, so some specialized stuff to be aware of. Well, I think we've covered a lot of ground here. To sum it all up for our listeners, group life insurance, it covers multiple people under a single policy, often through your employer. It's different from individual insurance in how it's underwritten, who owns it, and often the cost. We looked at contributory and non-contributory plans, who's eligible, how risk is assessed, that conversion privilege if you leave your job, naming beneficiaries, and then some other types of group life insurance like credit life and blanket life, as well as the special programs for military and federal employees. And then, of course, we talked about taxes, both on premiums and payouts.
Yeah, we covered a lot. Hopefully it's all a bit clearer now.
Exactly, that's the goal, to help everyone understand this stuff.
So here's a final thought for our listeners to chew on. Group life insurance isn't always portable, meaning you can't always take it with you when you change jobs. So how does that factor into your financial planning, your long-term security? And what does that conversion privilege make you think about when you're weighing the convenience of group coverage versus maybe needing an individual policy down the line?
Those are some really good questions to ponder, as you think about your overall financial well-being and how life insurance fits into that.
Definitely. All right, thanks for diving deep with us today, everyone. Hope this shed some light on group life insurance. See you next time.